Good afternoon, my fellow traders. My name is Michalis. I'm one of the market analysts here at HF Markets. And today we're going to be looking at the part two of a webinar that we've already done approximately 3 weeks ago. So we did a webinar where we were looking at chart analysis, we were looking at chart patterns, we were looking at how to find and determine what certain patterns means within the market. Now, we looked at that 3 weeks ago. We looked at it as a preset presentation. We looked at the theories. We looked at what each should we say breakout meant, how and different factors of support and resistance levels we can use as part of our analysis. We also looked at how to use this to determine potentially where there's opportunities within the market. But we got a lot of feedback, which was, great feedback. And, even today, and like I always say, the more feedback everybody gives me, the better it is for me. And to be honest, it was one of those webinars where all of the feedback was the same. Everybody said, I've learned so much. I now learned about harmonical patterns. We learned more about support and resistance. We learned more about trends and certain patterns like ascending and descending triangles. The list goes on and on. But people said to me, it's great to learn about it, and it was very educational, but what I want is I want to be able to see on the MT5. So now I've learned about it. Let's look at it on the MT5. Let's find out how to trade it. So this is what we're going to be doing as part of today's webinar. We're not going to look at the presentation. I've got the list of everything that we looked at here on the presentation. But what we're going to do is we're going to look at it on the live real-time MT5. So today we are going to be looking at all of those patterns, but we're also going to be looking at, generally speaking, live analysis, how to determine where there's opportunities within the market, but also how to determine where to put your stop loss, where to put your take profit, to look at reward to risk ratio on live on the MT5. And also something which not a lot of people speak about. We do speak about it on some of our more advanced webinars, of course, but also what are institutions doing within the market. We're going to look at that today as well. So this is what we're going to be looking at as part of today's webinar. We're here in my studio. This is actually where I do a lot of my trading, actually, because it's nice and quiet and cozy. So let's get started straight away, looking at all the different elements, different price patterns, price action, trend analysis, trade analysis as well. We're going to look at all of this right away. Now, before we get started, I want everybody to be aware about two things, only two things. The first thing I want people to be aware about is if you have questions, let me know. If there's something you don't understand, ask questions. Also, if there's something that you personally want to share, which you would like us to look at live on the MT5, then of course let me know as well. I will try and get everybody involved as much as possible as part of today's webinar. We will be releasing polls and people will be voting and speaking about how they think the market is going to develop throughout the day and throughout the week as well, because I can see we've invited and some professional traders have joined as well. So this is the first thing I want people to be aware of. The other thing I want people to be aware of as well is, of course, this webinar is here for educational purposes only. I'm not here to give financial advice. People know me within the industry very well. Most people know that I've been a financial advisor for many years. People know that I'm licensed, but I'm not here to give financial advice. People can, of course, seek independent financial advice, but these webinars are here for educational purposes only. So the first thing I wanted to look at, ladies and gentlemen, is support and resistance points. Now we can look at different examples of support and resistance points. So for example, here we've got the price of gold. This is the price of gold between August to the beginning of September, so approximately a month ago. Was a very strong area where the price was finding resistance. And also, very clearly, the investors were willing to sell at that level. They were willing to continue supporting gold simultaneously, but at the same time, they were not willing to purchase above that price. So it's very easy to simply look at a chart and say, okay, we're currently at a support level. Okay, we're currently at a resistance level. To be honest, that's very basic. And by looking at that, it's not going to help you analyze the market. You're not going to really be able to determine how the market is going to move. I can guarantee people, if you're looking at support and resistance points and saying to yourself, you know, if it hits this price, then I should straight away just speculate the price will decline. If you do that, then even though on this occasion, you know, if you did it here, you did it here, here, and here, and so on, most of the time you would have been correct. But if you keep doing that, then I guarantee you, you will not succeed as a trader. Trading and chart analysis, it's not like art, that if you hit, you know, like a drawing book where you have to stay within the lines. When you're analyzing the market, it's not that easy. We have to be able to determine the intrinsic price of the asset. So one of the things that I looked at in the previous webinar when we looked at chart analysis is one of the things we said is when you're looking at support and resistance, here, for example, we're looking at a support level at this blue line. We first went into, found support at this level on the 20th of August. We found support at that level again on the 26th, again on the 28th. So that's 3 occasions, 4 occasions here on the 29th, and then we found resistance at that level again on the 6th of September. What you notice is that even though the price is collapsing at that level, and even though buyers are losing momentum, they're no longer buying at that level, a lot of people are cashing in their profits, they're actually selling at that level as well. We also have to take into consideration that even though that is happening, sellers are not controlling the market in any way, shape, or form. So you can see, yes, we decline. Sometimes we're declining approximately to this level here, and sometimes we're declining to a slightly lower level, which is at this level here. So even though buyers are losing momentum, sellers aren't able to gain control of the market. Here, for example, we've got 2 trend lines. We have the traditional trend line, which is this red line. This is a 75 bar exponential moving average. We've got a price sentiment line here as well, which is a 100 bar simple moving average. And we've got an RSI also. You can see, other than this area here, ladies and gentlemen, even though a lot of the time the price is collapsing, let me get my pen out. You know, we can see the price collapsed here. It's quite a strong collapse. It didn't drop below the trend line. Again, we found resistance here, we found resistance here, we found resistance here. It didn't drop below the trend line. The only area we dropped below the trend line was here, and we dropped below the trend line here as well. So we never really getting an indication that sellers are controlling the market, and there's good reason for that as well. Keep in mind, between August and September, we knew the Federal Reserve was about to cut interest rates. We also knew geopolitical tensions were escalating. It was getting worse and worse, and we also knew that the economy was slowing. So we've got 3 factors here, ladies and gentlemen, which are giving us no indication that the price of gold should be declining. And we've also got technical analysis indicating the exact same thing. So we're finding resistance at this level, ladies and gentlemen, and there is opportunity, of course, 100% to look at some short-term trades speculating the decline. But we're having no indications that actually sellers are controlling the market and that this resistance point is not going to be broken. So you can see the way I'm thinking as a trader. I'm looking at whether buyers or sellers are controlling the market. I'm trying to determine how the market is trying to drive the price. And I know that, you know, the market, they are selling. They're not willing to buy above that price, but slowly the price target is getting higher and higher. Because what is actually happening is, you know, when you've got a resistance point, So, you know, the price increases, it collapses, it increases again, it collapses, and it collapses, and it collapses again. What actually happens is, you know, traders become more comfortable with this price because we increasing up to that price, we increase up to that price again, and we keep testing that level. So as it keeps testing that level, traders become more and more and even more comfortable with that level. It's like, for example, if I'm searching for a property, okay, and I go to a real estate and they say to me, you know, I've got this property, it's $500,000. And I said to them, I'm not willing to buy at that price. So I keep looking. I want to buy a property. I keep looking. He comes to me again. He says to me, you know, there's this property, is $500,000. I said to him, you know, I'm still not willing to buy. And if he keeps coming to me throughout the next 6 months and nothing which I'm looking for is below that price, then of course I'm going to give some leeway. I'm going to become more comfortable with the price, and I'm going to be more willing to pay for that price. And the same thing happens to resistant levels. You know, we hit on one occasion, a second occasion, a third occasion, a fourth occasion, a fifth occasion. You know, the more times it's hit, the weaker it is going to get. And the same thing applies. Okay, it depends on the asset. Okay. For example, with downward price movement, if we're looking at the stock market, then again, sometimes support levels can be harder to pressure and break below that level because people are buying, shareholders are buying, everybody's buying. The only way these people that are buying are going to make profit is, of course, if the price continues to increase. So there's a slight more bias for the price to increase. So slightly different, for example, with assets such as stocks, such as ETFs, such as indices, which are more related to an investment which only people are going to profit if it's increasing in value. Whereas if we're looking at currencies, when we're looking at commodities, there's other factors to take into consideration. So we have to be slightly cautious in regards to, if we're looking at the NASDAQ, the S&P 500, we need to say, you know, is there really something driving the price lower? You know, if there's a stock market crash, if there's geopolitical escalations, terrible earnings, things like that, then we can take into consideration the support level being, you know, being broken. But coming back to gold, and we can see here, you know, after the fifth occasion, we're looking at now the fifth occasion. This is the fifth occasion here. It's the fifth occasion. It finds resistance again. What are we actually seeing when it finds resistance? Let's get my pen out. So we're finding resistance here for the fifth occasion. I know from experience that, you know, if we really keep testing these levels, there's a higher possibility that it's going to break, especially if it's been tested more than 4 times. We know that fundamental aspects of the market is indicating that the price is going to increase. Like I said, lower interest rates, slowing economy, geopolitical tensions. We have to keep into consideration that gold is a safe haven asset as well. So I know, you know, it's found resistance at this level. Fair enough. The decline only took place in one candlestick. It wasn't able to maintain that decline in any way, shape, or form. For example, it didn't look anything like this. If we compare the measurements of this retracement to the measurement of this retracement, it's much smaller. We're on a higher low. So now you can see how I'm using price patterns, resistance points, price action, technical analysis. So I know now there's an increased possibility that indeed the price is going to actually start to see buyers gaining control of the price. So, you know, the price, as it breaks above this level here, we've got a bullish crossover as well. So this is another indication. If we're looking at the RSI is also on a higher high. So we've got what is known as convergence there. We're not looking at something like divergence. If there was divergence, then that would be a concern. So we've got very clear indications. You can see how I'm looking at resistance points, how the resistance point is being tested, how I'm looking at price action and the price pattern to give me an indication that actually gold is going to really start to see buyers controlling the market. And we can see again that buyers are controlling the market. So we can see since that point, since we were looking at that resistor point, we're significantly higher, significantly higher. So we can see we're now, if we're looking at the current price, we're almost 5.5% higher. So let's switch over to a different time frame. I'm going to go more onto a medium term time frame. So here, for example, we're looking at a 2-hour time frame. Now, there's a couple of things for us that we can take into consideration. Another thing that we looked at in the previous presentation is what is known as the head and shoulder pattern. Now, if we look at gold, we saw a head and shoulder pattern. So you can see basically we had the high here. Below that, before that, we had the lower high, and after that, we had the lower high. So we can see we've got basically a pattern that looks like this. So this is why it's known as the head and shoulder pattern, because you've got the head here and we have the left shoulder and the right shoulder as well. Now, the head and shoulder pattern, the classical head and shoulder pattern like this is an indication that the price will decline. So, you know, as the price increases here, ladies and gentlemen, I have in mind that actually potentially the price is going to see a correction. What happens after that? The price does indeed see a correction. The classical head and shoulder pattern, like we can see here, is known to be a slightly more bearish indication. Of course, if the price continues to increase and, for example, increases somewhere up here, then it's not a head and shoulder pattern. So if we are getting a classical head and shoulder pattern, you know, that looks, like I said, like this, then that is an indication of downward price movement. If we see a reverse head and shoulder pattern, so basically something that looks like this, then this is an indication of upward price movement. Now, some people may be saying, if it was bearish, why is the price increasing now? Guys, the price did decrease. You know, the head and shoulder pattern formed here, and we can see the price decreased all the way down to here, ladies and gentlemen. Now, as the price decreased, we can see we're in that bracket, very important bracket, the bracket between the trend line and the price sentiment line. So we're at a very key area that a lot of the time buyers re-enter the market. We said that again and again in a lot of our webinars. So we retrace back to that level. So a lot of the time that's where buyers re-enter the market. And you can see indeed that's where buyers re-enter the market. Now, there's a lot of things that I will say to you as part of this webinar. For example, myself, I've been a financial advisor for many years. And, you know, large institutions, they want to take advantage of the upward price movement. But then what they want to do is they want to, yes, take advantage of the upward price movement, but they want to buy as low as possible. Okay, keep that in mind. It's like, for example, if I say to you, you know, this price is going to increase in value, would you rather buy at $500,000 or would you rather buy at 600,000 US dollars? You're going to say $500,000, of course. Yes, you want to buy the house which is going to increase in value, but you want to buy it at the lowest price possible. You know, large institutions, they want to do the exact same thing. And when they, so what they do is, you know, they try and push the price slightly lower. They'll hold back you know, people that have been buying in these areas here, so you know, they're buying, they start to slowly close positions. They want the orders, the buy orders to slightly lower. They want the price to slightly decline. What they also want to do is people, you know, people that are buying here, for example, where are they going to put their stop loss? I can tell you where they're going to put their stop loss. People that are buying here are going to put their stop loss in this area of the market. That is the traditional area where everyone's going to put their stop loss. They've got the low here. They're going to say, you know, if it crosses to the lower low, then I'm out of the market. I don't want to risk that. So, you know, people that are buying here, they're putting their stop losses in this area of the market here, ladies and gentlemen. So the large institutions that drive the price down and they knock all of the buyers out of the market. A lot of people start to sell and there's more sell orders waiting to be picked up. So what happens is, when they get to that area of the market, the large institutions take advantage of that. There's a lot of sell orders now. So basically, there's a lot of easy ways they can easily buy at a low price. Because keep in mind, here there may be, for example, 30 million sellers and there's 100 million buyers. So if institutions are buying at this level here, ladies and gentlemen, they know that some of their orders will be purchased at 2,685, but some of the orders they want to buy, it will be at a much higher price. Why? Because there's a lot of buyers here and very few sellers. As they drive the price down, more and more and more sellers come into the market. So, down here, for example, let's say in this area of the market here, there may be 100 million sellers. So it's like an auction. There's a lot of sellers. There's a lot of things available, basically. There's a lot of supply within the market. So they can swoop that up. They can buy all of that without actually the price of the market sparking up. So they're buying at a very low price. And of course, as they buy that, the price slowly will start to increase. But they don't. That's what they want. They want the price to increase, but they want to buy at the low price. And they want, as they're buying it, the price not to very quickly increase in value. And then they have to start buying at a very expensive price. So that's what's happening. The price, again, is driving upwards, ladies and gentlemen. Indications, here we're above the trend line. Here again, we're above the sentiment line. We're between the 50 and the 75, so clear indications buyers are controlling the market. And it's actually moving hand in hand with the US dollar, which is amazing. That's something that I spoke about earlier this morning. Some people think inversely correlated, the US dollar and gold, but if you see that as moving hand in hand, we need to use that as an indication. It's no longer, inversely correlated. So if we switch over to a smaller time frame here, for example, we can see we're trading extremely high. We've seen a lot of upward momentum, but as we've seen upward momentum like this, a lot of there's a larger possibility the price will, decline, because if we look here, the price is overbought. If we look at the stochastic oscillator, again, it's overbought. But, in addition to that, we can see we've got a high here and then it's a lower high. Whereas here, we've got a high and a higher high. So what is that? That's basically divergence, ladies and gentlemen. So that's divergence. That's also an indication the price is extremely high. Here, we're looking at the MACD. Again, the MACD is extremely high. We're trading above the Bollinger Band. So we do have a lot of indications here that the price would decline. If it is going to decline, potentially it can decline to the previous low, the previous high. So that's one area we can look at where maybe institutions will look to buy at that area. Alternatively, traders may drive the price to this area here. So those are two areas we're going to look and take into consideration. If it's going to decline to that area, our institution's going to take advantage of that and purchase at that level. Alternatively, we can look at the trend line. So here we've got a 250 exponential move, simple moving average. We can look at that as an area where buyers will enter the market. So those are two things that we can take into consideration. Now, if we do get a decline, for example, if it's going to decline like this, let's just say for an example, then it doesn't mean we're in a downward trend. Like I said, when we were on that upward, when we were looking at the 2 hour, we're above the trend line. We've got indications here that buyers are controlling the market. We're still quite a way as well. If we look at this as a resistance point and looking at that as a resistance point, we're quite a way from our resistance points. We've got some time there to take advantage of the trend. So if we're going to see a retracement like this, we basically just want there to be momentum up, enough momentum upwards regained in order to basically take advantage of the price. Now, some people may trade the breakout. If it declines all the way down to here, you have to, if you want to trade a breakout, you have to wait for the price to increase, almost 0.50%. So you missed most of the price movement. The price may be overbought again by the time we get to that price. And you're going to risk there not being enough momentum for you to actually then take advantage before the price finds resistance again. So we can draw the Fibonacci levels as part of that. So I use the Fibonacci from the high and the retracement low. If it's going to increase above the 65 level, so for example, here we have a 65 level. Now, as it increases upwards, like it is doing now, I'm going to amend my Fibonacci. So at this blue line here, ladies and gentlemen, if it declines down to here, like so, and then it increases upwards, if it increases back above this blue line, we can potentially use that as an indication on that the price is going to again increase in value. So this is something we can also take into consideration, ladies and gentlemen. Now, something very interesting today is that gold is extremely strong. Also, the US dollar is extremely strong. Something which is also very interesting is that the euro is extremely strong. That's extremely weak. Eurozone inflation was terrible. It wasn't better than expected today. Yesterday, German inflation underachieved again. Definitely slow in economy, lower inflation. The president of the ECB yesterday came out and said, we're going to take into consideration another interest rate cut. There may need to be 2 more interest rate cuts by the end of the year. So a lot of fundamental factors there supporting the fact that actually the euro is going to come under pressure. So that is also something we need to take into consideration. What is going to influence gold in a couple of minutes, as well as the US dollar, is I'll get my calendar up, so I'll actually confirm the announcement as it actually takes place. Something which is going to create a lot of volatility is actually the job openings. So let me get my calendar up so I can confirm that as it's released for everybody. There we go. So we've got 2 minutes, and then I'll confirm that as well. So before we start to look at another asset, let's actually see what people think is going to happen to gold this week. I'm going to release a poll. Here we go, ladies and gentlemen. Will gold end the week higher or lower than the current price? Will gold end the week higher or lower than the current price? So higher, lower, or little change? So what does little change mean? It will end the week at the price we're currently at. I want at least 60% of people watching today's webinar to vote. Currently, we're only at 40%. So I need 60% of people to vote, and I will confirm to everybody what people actually voted. We're currently at 50%. 55. I want some more people to vote, guys. I want 60% minimum. Still at 55, 59, 60. Great. Okay, so I'll end the poll. There we go, and I'll share the response. This is very interesting. So 52% believe that gold will end the week higher than the current price. 35% believe it will end lower than the current price, and 13% think it will end. We'll see little change. Okay, so some people think it will be at the same price. Most people think it will end higher. Some people also think it will end lower. So that's very interesting. Let's look at the announcement. The announcement will take place. It's just been released. 8 million, ladies and gentlemen, 8 million new vacancies in America. 8 vacancies, new vacancies in America. That's much higher than expected. Much higher than expected. The other thing, though, is that the ISM manufacturing index was significantly lower than expected. Actually, significantly lower than expected. It was expected to come in at 53.5, came in at 48.3, and that's the lowest we've seen in a very long time. Maybe geopolitical tensions is driving that price slightly lower. The last time we were lower than that, ladies and gentlemen, was back in January. So almost 10 months since we've been that low. Now, if that wasn't lower, I would have said that announcement can potentially actually be negative for gold. If the ISM manufacturing index was higher than expected, like the job opening was higher than expected, then I would say that that would have been negative for gold. So, I mean, we said before, I'll draw that line again just to help people. You know, we said before the price would do something like this. It retraced to here, so halfway. If both were higher than expected, I would have said, you know, would have gone all the way or down to here. But because it's 50-50 now, it's something we need to keep on monitoring. What I will say though is, as it breaks above this level, if it breaks above, we need to be cautious. So that's something I will say. So let's continue looking at different assets and continue looking at different patterns. We've looked at resistant levels. We've looked at retesting resistant levels. We've also looked at head and shoulder patterns, reverse head and shoulder patterns as well. So these are some of the patterns we've looked at. We haven't looked at support levels just yet. I will look at support levels actually. I'll try and find a support level that we can take into consideration. These are all gold. Let's actually go back to the 2-hour time frame. Let's look, for example, at the Dow Jones. So the Dow Jones is something that we can see a very clear support level. Look at this support level here, ladies and gentlemen. This is a clear support level. So this is an area that if the price declines to this area, then we're going to take into consideration, you know, are we going to find support at this level? If not, it doesn't mean guaranteed we're going to find support at that level. You know, if it declines to that level, you know, it will take some time. Maybe we'll get closer to earnings reports. So if we're going to decline below that, we need it to be further back by fundamental factors. So for example, if United Health Group, Goldman Sachs, JP Morgan, if all these companies start to, which are very important companies for the Dow Jones, start to release negative earnings, then by all means, of course, 100% it can decline below that support level. But unless we're going to get something really driving it lower, then if we're going to decline below this support level, we need to take into consideration, are we going to find support at that level? So it doesn't mean automatically you start to trade against the trend. You know, the trend is your friend. It's not trading against the trend. You're basically just keeping an eye on it and saying, if the indication changes, then we're going to take into consideration that buyers are buying at that support level. It doesn't mean it's hit that support level before momentum starts to climb again. I'm going to straight away start to speculate and the price is going to increase. No, because you're speculating before the price even gets an indication that it will rebound back upwards. So that is, for example, also support level. We had an example of a resistant level. I wanted to give you an example of a support level as well. Now, something else we looked at is an ascending and descending triangle patterns. So let's go to the US dollar against the USD. Some people, a lot of the time, they ask me, US dollar, you know, what is the best asset for me to trade? And it's not something very easy to answer. What I can say is, though, there's benefits to certain assets. For example, there's benefits to the euro against the USD because it's the cheapest asset. It's got the lowest spread, it's got the lowest swap fee. Something else which is very popular as well is the NASDAQ and the British pound against the Japanese yen. Now, if we're looking at here the euro USD, on average, we're finding resistance at this level here. Now, I say on average because, you know, sometimes we're at this level, sometimes we're at this level, sometimes we're higher though as well. I would say on average, this is where the key resistant level is. But if we're looking at actually the lows of the price, ladies and gentlemen, is actually here. So what we're actually seeing is an ascending triangle. So you can see here a very clear line there, but the lower line is ascending. So this is why it's known as an ascending triangle. And as we were trading in this area, you know, a lot of traders would have been, yes, a lot of the time there was areas you could have speculated a decline, of course, but there would have been trading with a bias of upward price movement. You know, we're breaking below that though. We've definitely broken below that. So, you know, that ascending triangle is no longer indicating upward price movement. We're trading below that. Latest crossover here is a downward crossover. We're trading below the trend lines. We've got clear indications here of downward price movement as well. There's no divergence there. We've got very clear convergence. But there's a but here. Number one, we're at a support level. So here we can see is a support level. That's one thing. Number two is retracing upwards. So the momentum is upward at the moment, even though the longer term momentum is downward. So I'm not trading downward price movement while the price is increasing. This is another thing as well. Another thing is we were considerably lower than the previous low, and we were declining for you know, throughout the whole of the day almost. So there is some indications there that say to me, you know, are we going to get a pullback? I don't want to trade as part of the pullback. So now that a pullback has formed, you know, we were here, but we now all the way up here. What I'm going to do is, again, I'll go into a 5-minute time frame. So let's go to here. Let's go to a 5-minute time frame, like so. And let's go to today's pricing. There we go. So now we can see the price retraced upwards. So as it's retraced upwards, we were down here, ladies and gentlemen. We were all the way up here. It could potentially continue to retrace. It could retrace all the way up to that trend line. This is the reason why we've got this here on the 5-minute, a 100-bar simple moving average. Some people also have a 250-bar simple moving average. It's completely up to you. Depends on the volatility of the asset as well. At the moment, I've got 100. You know, based on that, it's been a great tool. Very, very helpful tool. It's been below it the whole day. If I've been trading downwards the whole day, you know, it's an amazing signal so far. But it's retracing upwards. So far, it's retracing all the way up to here. Like I said, 65. Some people use the 65 level. Let's look at the properties. Some people use the 65 level. Some people use the 63 level. It's completely down to you. So for example, here I've got the 63 level, and I've got the 61.8 level here. So let's get rid of one. And let's look at the 63. I'm actually going to get the 63 as 0.65. 0.65. Okay. So you can see I've got the 0.65 level here. So I'm going to draw a line there. That's going to be my breakout point. That's a great breakout point. Why? Because if it declined to the 50, which is here, you know, that potentially could be a head and shoulder pattern that we spoke about before. So the price could increase up after that because we've got, you know, a head and shoulder pattern. So that's something we need to be cautious about. Whereas if it completely goes below that and it declines not to 65, but it's going to break the 65. So for example, if it does this and it's just broken the 65, I've not got a head and shoulder pattern, what is known as a reversed head and shoulder pattern. So that could be an indication of the price is going to decrease further. Now, fundamental factors. JOLTS job openings are significantly higher. It's not just higher, but significantly higher. But the ISM manufacturing index was significantly lower. So again, unfortunately, fundamentals at the moment is 50-50, so we need to be slightly cautious about that. But again, if we're going to get a breakout, we can take it into consideration. What we may want to do, because the fundamental factors are 50-50, is we may want to keep that short-term trade lower. So a lot of the time, people, you know, as we get a decline like this and it retraces upwards, we draw the Fibonacci, they may enter here. So that's where we entered. You know, they'll try and exit the market here. Because fundamentals at the moment is 50-50, they may exit this level here, so slightly earlier, which isn't an issue. Still profit, ladies and gentlemen. It's just an earlier exit point for us to take into consideration. That's something for us to look at. Now, I've also got a poll for the euro. I've got a poll actually for the US dollar against JPY. So let's look at the US dollar JPY. Look at that on a 5-minute time frame. Very interesting. This is why I've got the 5 minutes, the 100 bar simple moving average. Look at this. You know, it declined back to that level here, started to decline again. Went back to that level here as well. Again, it's not going to go to the line and it has to decline. Sometimes it may be slightly higher, sometimes slightly lower. Again, shot downwards after that. Went back up to there again, shot downwards. Look at momentum here, guys. Definitely in favor of the Japanese yen. Look at this momentum in favor of the Japanese yen. That's something for us to look at. Let's go to the 2-hour time frame as well to take a look at that. US dollar against JPY. Guys, it's back below the trend line, below the sentiment line, below the RSI as well. So that's very interesting. That's something for us to take into consideration. If it's going to start to, if people are buying here, it starts to rise, you know, if it's going to come back up to the trend line, again, maybe the large institutions trying to knock people out of the market, potentially, that may be an area to re-enter the market as well. But to be honest, as I'm speaking, it just keeps declining. But either way, there's fundamental factors as well supporting both the US dollar and the Japanese yen. The Japanese yen, especially though, because they're likely to increase interest rates again this year. And they're the only major bank to consider increasing interest rates. So, ladies and gentlemen, that's something for us to take into consideration. But you can see why I've got 100 bar simple moving average. Like I said, a lot of people also look at the 250 bar. It's not really helpful though, to be honest. On this chart, 100 is much better at the moment based on where we're finding support and resistance. So this is something for us to take into consideration. Now, let's say somebody's, one of the things I wanted to look at is where to put your stop loss in terms of your reward to risk ratio as well. So let's say, for example, people, they drew a Fibonacci point here, like we said before. So they would have been buying, ladies and gentlemen, here. That's where they would have bought. You know, increased all the way up to here, started to decline again. They would have bought at this area here. It's still in line with technical analysis. Look, this high is higher. Sorry, from this low, we've got lower highs here as well, still lower highs, a lower low as well. So it's still in line with our technical analysis and price action. Now, as it's declining, ladies and gentlemen, like I said, let's get rid of this blue line here, just so it's clearer for everybody. Let's get a pen out. There we go. So like I said, you know, as it declined below the price here, that's where we would have speculated the decline. So this is the sell trade, okay? A lot of people would have put their take profit either here, in which case it's already hit the take profit. Some people would have put it here. Some people, they could have put it higher, further away. There's different theories. We'll look at that in a moment. But let's say we'd just say for this example, let's say we put in our take profits at the 138 level, just for an example. Now, if we enter in here, we're putting it at the 138 level, so that's 0.34 pips, 0.33% away. Now, if we want, so that's where we put in our take profit. That's our take profit here. Now, depends on our success rate. If we've got a success rate which is slightly higher than neutral, so let's say maybe at 60%, 65%, then people may want a classical 1-for-1 reward to risk ratio. Now, if we're looking for a classical 1-for-1 reward to risk ratio, then we need our stop loss to be 0.33% away. So that's just here. So I'll put there as well. That is where our stop loss will be. And that's a reward to risk ratio of 1-to-1. That would be appropriate if you have a high success rate or a slightly positive success rate. Now, people have a much lower success rate. Let's say they've got 40%, which is a low success rate. They may want to have, for example, a 3-to-1 reward to risk ratio, in which case it's going to limit themselves in where they can put the stop loss. So the take profit is at 0.33% profit. So if they want a 3-to-1 ratio, then they need their stop loss to be at 0.11. So if we look at 0.11, it is there. So our stop loss will be here. So you can see the take profit is much further away here, and the stop loss is here. So you can see we're not giving the market a lot of time, but we're not doing so because our success rate is lower. So if we're opening 10 trades, 4 of those trades are closing a profit, 6 are closing a loss. So because I've got a low success rate, I want a higher reward to risk ratio. So it's not negative to have a high reward to risk ratio. It's not negative to have a like for like reward to risk ratio. What's important is that the reward to risk ratio is in line with your success rate. Let's release another poll. So will the US dollar JPY end the day higher or lower than the current price? Will the US dollar against JPY end the day higher or lower than the current price? Will it be higher, will it be lower, or will it be little change? Again, I want at least 60% of people watching today's webinar to answer this. Guys, I've only got 39% answered so far. I want as many people answering this as possible. Again, only, we've got some more people answering. I want at least 60. We're currently at 50%. Come on, guys, let's get to 60% answering the poll. Will the US dollar against JPY, this is to help you guys, by the way, will it end lower or higher than the current price? It's very even at the moment. We're at 53% voted. I needed to be at 60. We need a few more people to vote. I can see it's increasing. Yep, it's increasing. We need more people to vote. Only 5 more seconds. Perfect. Somebody's voted. We're now at 60. So let's share the results. 35% believe it will end higher. 45% believe it will end lower. 20% think it will end more or less at the same price that we're currently at. So most people think it will end lower. Some people think it will end more or less the same. Some people think it will end higher. Somebody here has said, there's a lady, very good question. Is it probable to assume that the price will retrace to soak up liquidity from the decline? Yes, of course it is. Which is why we always say, you know, I said at the very beginning of the webinar, I'm not sure if you were here from the beginning. I said at the very beginning of the webinar, you know, traders, professional traders, they always will look at the market and say, where are people going to put their stop loss? Where are people going to put their stop loss? This is one thing I'm always asking myself. Where are people putting their stop loss? Another thing, where is the market trying to drive the price? If you think about these two things, it will be extremely, extremely helpful for you. Now, the last thing I want to look at, and we'll do one more poll, one very last poll as well. Let's go to the NASDAQ. Look at the NASDAQ's decline, ladies and gentlemen. I think the decline is coming largely because people don't think we're going to get a 50 basis point interest rate cut anymore. So they're pricing in a 25 basis point, and also that the ISM manufacturing index was extremely, extremely low. Also escalations in the Middle East as well. It's a big factor. What I will say is, of course, let's go to a 2-hour time frame. Let's go to the NASDAQ. We're considerably lower now, considerably lower. We're below the trend line, sentiment line, we're below the neutral as well. So we've got indications here that sellers are controlling the market. Think about where traders will drive the market. If we continue to get negative data, then potentially it will decline lower. Sometimes we look at, the support, the resistance level being flipped onto the support. Now it's at the neutral level. People may be tempted to use this to purchase the discounted price. Maybe they'll want it to decline slightly lower before they consider purchasing the discounted price. We need to keep monitoring it. What I will say, ladies and gentlemen, let's go back to the 5-minute time frame. The last thing I'll look at, which we looked at in the previous presentation, is you don't have to have one target. If you're not sure about the market, if you're not sure if you'll continue to decline, let's say, for example, you think you want the price to decline down to here, you think it may decline down to there, but you're not entirely sure it can maintain that much momentum. If you're going to open 1%, open 2 trades, which are 0.50% each, for example, and then have 2 exit points. So you've got target 1, target 2. So 0.50% of the trade, 0.50 lots of the trade, you will exit here. 0.50 lots of the trade, you will exit here. So yes, you're cashing in a quicker take profit, which is lower risk because it's a quicker take profit. But at the same time, you're also leaving a percentage for a larger profit. Now, if you've got a high reward, if you've got a high appetite, risk appetite, you may look at 50%. A very well known for people with high risk appetite is 65 at the first target, 35 at the second target. That could be percent, that could be in terms of lots. Now, if you've got an ultra low risk appetite, you're really cautious, you don't want to do something like that, you can still look at 2 targets and try and scale in and scale out. Well, it's actually scaling out, not scaling in. Then you can look at, for example, 0.85 lot here, and then 0.15 lot here. So this is also something you can take into consideration. If the price is going to increase in value, when it gets back to here, that's where we need to be cautious again. Keep that in mind. So let's have the last poll, because we've been speaking now for 50 minutes and I don't want people to keep people here for too long. And then we'll end today's webinar. Will the NASDAQ end the day lower or higher than the current price? This is the last poll of the day. People are voting much quicker. If people have questions, by the way, feel free to ask. Somebody says here, will you send the webinar to our email? Yes, of course. The email will be sent with the webinar recording on Thursday. 50% have voted. I want at least 60. Nobody has said little change, so this is very interesting. I need at least 4 more people to vote for us to get 60%. So come on, guys, we need some more people to vote. I need only 1 more person to vote. 1 more person, guys. And then I'll be able to release the poll results. There we go. We had 1 more person. Great. So let me share. So will the NASDAQ end the day higher or lower than the current price? 37% said higher. 63% said lower. Nobody said at the same price. So most people think the NASDAQ is going to decline by the end of the day, decline more by the end of the day. So that's the end of today's webinar, ladies and gentlemen. If anybody has any questions, feel free to ask now. I will allow a few questions. Otherwise, we'll end today's webinar. So today's webinar, guys, it was more live analysis, more of, it wasn't so much, theory step by step. look at certain patterns, what they mean, because we've already had that webinar. We had that webinar where it was a presentation and we looked at everything in a very, very simple way. This is kind of part 2 of that webinar. We've looked at it. We spent an hour and a half talking about it and understanding it. Now it's about looking at it on the charts. A lady, I won't say any names. I always never say any names. So she enjoyed the webinar. Thank you. No, thank you. I thank you. Thank you for joining. I'm glad you found it educational. I've got some more people saying thank you, great webinar. Some people here I can see is requesting the recording. The recording will be sent out on Thursday. But I can't see any other questions, so let's end today's webinar. So enjoy the rest of your day, guys. Hopefully you found it educational. In the meantime, we'll see you on our next webinar. Goodbye.